In 2026, the average American family is working more hours than they did 10 years ago, yet their share of the economy is shrinking. Not slightly, dramatically. According to projections based on recent institutional reports from firms like BlackRock and Vanguard, the top 1% now control over 35% of total U.S. wealth. And that number is still rising. But here's the strange part. There hasn't been a major economic collapse. There hasn't been a global banking meltdown, and there certainly hasn't been some dramatic transfer of money overnight. Instead, the wealth transfer happening right now is almost invisible. It's happening through inflation, through asset ownership, through financial systems most people barely understand. And if you don't understand where the money is moving, there's a good chance you're standing on the wrong side of the transfer. Because what we're witnessing right now may become one of the largest silent wealth transfers in modern financial history. 2026 economic context. Let's zoom out and look at the bigger picture. As we enter 2026, the economic environment looks very different from the one investors got used to over the past decade. The Federal Reserve has stabilized interest rates around 4.5%. Inflation is still higher than historical averages, and governments across the world are pouring trillions into infrastructure, energy transition, and industrial reshoring. Large institutional investors are responding accordingly. BlackRock recently highlighted a major shift toward what they call real-world assets, or RWAs. This includes things like infrastructure, energy systems, commodity supply chains, real estate tied to logistics, industrial manufacturing capacity. In other words, while many retail investors are still chasing the same strategies that worked in 2020, high-growth tech stocks and speculative assets, institutional capital is quietly rotating into hard assets and cash flow-producing investments. And that shift is creating the conditions for a massive redistribution of wealth. Because the people who understand this shift early position themselves before the rest of the market catches on. The wealth gap mechanism. To understand the silent wealth transfer, you have to understand one simple rule of modern finance. Assets rise first, wages rise last. This has been true for decades. When central banks inject liquidity into the financial system, that money doesn't flow evenly across the economy. Instead, it enters financial markets first. Stocks rise, real estate rises, private investments surge, and only later does that money filter into wages and the broader economy. This creates a powerful effect. If you already own assets, your wealth grows early in the cycle. If you rely mainly on wages, you feel the inflation first, but you benefit from asset appreciation last, if at all. And that gap is where the silent wealth transfer happens. Pillar 1, ownership of cash-flowing assets. Let's start with the first pillar of wealth creation in this environment. Ownership of cash flow-producing assets. Not speculative assets, not hype-driven investments. Cash flow. Think about assets that generate consistent income regardless of market noise. Examples include energy infrastructure, utility companies, transportation logistics, dividend-producing equities. For example, many institutional portfolios are increasing exposure to sectors like energy pipelines and midstream infrastructure. One ETF that tracks this sector is AMLP, which focuses on energy infrastructure companies. Why is this attractive? Because these companies generate strong free cash flow. Free cash flow is essentially the cash left after a company pays for operating costs and capital expenditures. In simple terms, it's the money available to pay dividends, reduce debt, or reinvest into growth. Companies with strong free cash flow tend to perform well during periods of higher interest rates. And that's exactly the environment we're entering. The $1,000 growth model. Let's run a simple hypothetical. Imagine an investor allocates $1,000 into a diversified dividend-producing asset yielding 6% annually. That generates $60 per year in income. But instead of spending that income, they reinvest it, Over 10 years, assuming modest growth and reinvestment, that $1,000 could realistically grow to around $1,800 to $2,000. Now scale that principle. Institutional investors are not investing $1,000. They're investing billions, which means the compounding effect becomes enormous. And that's exactly why large institutions prioritize cash flow stability over speculation. But cash flow alone isn't the full story. Because the biggest wealth transfers don't just happen through income, they happen through leverage. And that brings us to the second pillar of this silent wealth transfer, the strategic use of debt. Because in modern finance, debt can either trap you or accelerate your wealth. And understanding the difference may completely change how you view the financial system. Pillar 2, strategic use of debt. Most people hear the word debt and immediately think of something negative. Credit cards, car loans, student loans. Debt for the average household usually finances consumption, things that lose value. But in the financial system, debt plays a completely different role. For large investors, corporations, and institutions, debt is not a burden. It's a tool for control. Because when used correctly, debt allows investors to control assets worth far more than the capital they actually put in. And in an inflationary environment, that leverage becomes extremely powerful. Let's take a simple example. Imagine two people. The first person saves money in cash. The second person uses capital as a down payment to acquire an asset, like real estate or an infrastructure investment. Now, imagine inflation runs at 3 to 4% per year. The person holding cash slowly loses purchasing power, but the person holding the asset may benefit in two ways. First, the asset itself may appreciate. Second, the real value of the debt decreases over time, because inflation effectively erodes the purchasing power of the fixed debt payments. This is one of the most overlooked dynamics in modern finance. Inflation hurts savers, but it often benefits asset owners with leverage. This is one of the structural reasons wealth accumulates faster for investors than for wage earners. And it's why many institutional investors strategically use debt as part of long-term portfolio construction. But leverage alone isn't enough, because leverage without the right assets can become dangerous, which is why the next pillar focuses on something institutions have been quietly accumulating for the past several years: real-world assets. Pillar 3, the shift into real-world assets. In 2024 and 2025, multiple institutional reports highlighted a growing shift toward real-world assets, often abbreviated as RWA. BlackRock, Goldman Sachs, and several global asset managers have emphasized the same trend. Capital is rotating away from purely speculative growth assets and toward tangible economic infrastructure. Why? Because in a world of higher interest rates and persistent inflation, tangible assets become extremely valuable. Think about the physical backbone of the economy: energy production, transportation networks, data infrastructure, industrial manufacturing, supply chain logistics. These are not speculative sectors. They are foundational to economic activity. And when global investment cycles shift toward infrastructure and energy systems, the companies operating in these sectors can generate enormous and consistent cash flow. For example, many institutional portfolios include ETFs tracking industrial and infrastructure sectors. One example is PAVE, which tracks U.S. infrastructure development companies. Another is XLE, which tracks major energy companies. These sectors benefit directly from massive government infrastructure spending and industrial reshoring initiatives. In other words, while retail investors may still be chasing last decade's winners, institutional capital is quietly positioning itself for the next economic cycle. Let's run another simple model. Imagine investing $1,000 into an infrastructure-focused ETF, growing at a modest 7% annually. After 10 years, that $1,000 becomes roughly $1,967. Now add dividend reinvestment and periodic contributions. that same investment could realistically grow to $3,000 or more over that period. Again, the principle here isn't speculation. It's steady compounding in sectors aligned with economic reality. And that alignment is exactly what institutional investors are targeting. But even strong assets and leverage are not enough without one critical ingredient: liquidity. Because in financial markets, liquidity is like oxygen. You don't notice it when it's abundant, but when it disappears, the entire system struggles to breathe. Pillar 4, understanding liquidity cycles. One of the biggest drivers of financial markets is liquidity cycles. These cycles are largely influenced by central banks and government policy. When interest rates fall and central banks inject liquidity into markets, asset prices tend to rise rapidly. But when interest rates remain elevated and liquidity tightens, markets become more selective. Capital flows towards stronger balance sheets and real economic value. That's exactly what we're seeing as we move deeper into the mid-2020s. The era of ultra-cheap money that dominated the 2010s is fading. In its place is a new environment where cash flow matters, balance sheets matter, productive assets matter, and investors who adapt to this environment early are positioning themselves on the right side of the wealth transfer, risk management, and 2026 outlook. Of course, no investment strategy is without risk. That's where the concept of margin of safety becomes critical. Originally popularized by legendary investor Benjamin Graham, the margin of safety principle focuses on investing in assets where the downside risk is limited relative to potential upside. In practical terms, that means avoiding overpaying for hype-driven investments. It means focusing on companies with strong cash flow and manageable debt levels. And it means maintaining diversification across multiple sectors, because unexpected events can always occur. Financial markets are vulnerable to what economists call black swan events. Events that are difficult to predict but have enormous impact. Examples include geopolitical conflicts, global liquidity crises, energy supply disruptions, unexpected policy shifts from central banks. These events can temporarily invalidate even the strongest investment thesis, which is why disciplined risk management is just as important as opportunity recognition. So let's bring everything together. The silent wealth transfer happening right now isn't driven by conspiracy or hidden agendas. It's driven by the structure of the financial system itself. And 3 key insights stand out. First, asset ownership consistently outpaces wage growth. Second, leverage and inflation often benefit those who control productive assets. And third, institutional capital tends to move early into sectors aligned with real economic demand. Understanding these dynamics doesn't guarantee success, but it does allow investors to see the game more clearly. And clarity is one of the most powerful advantages in finance. If you want to track the sectors benefiting most from the current economic cycle, check out the 2026 Portfolio Tracker in the description below. It breaks down key sectors, ETFs, and macro indicators worth watching this year. And here's a question I want to leave you with. As capital continues shifting into real assets and infrastructure, do you think the traditional 60-40 portfolio strategy will still dominate investing over the next decade? Or are we entering a completely different investment era? Let me know what you think in the comments, because the investors who pay attention to these shifts early are usually the ones who benefit the most later.